Hey there, I'm Mike, the founder of Financeable, and today we're going to take a look at the concept of beta, which is a common interview topic for investment banking, private equity, and investment management. So just to give a quick lay of the land of what we'll cover here, we're going to start with just the general concept of beta. We'll then move on to how beta is calculated and ultimately applied. We'll then take a look at how you unlever and relever beta and the unlevering beta and relevering beta formulas. And then we'll take a look at how you can apply that to calculating the beta for a private company. We'll look at how you source beta, and then we'll wrap things up with the common interview questions related to beta that you're likely to encounter. So that's the lay of the land. If you find this video helpful, definitely hit the like button down below and subscribe. We have a lot more content coming. With that said, let's jump in here. To kick things off here, we're going to take a look at beta in the context of the cost of equity or CAPM formula. And what this formula is trying to capture is an investor's expected rate of return based on taking a certain level of risk. And the way we calculate this cost of equity is we start with the risk-free rate, which is the rate of return we'd expect based on taking zero risk as a starting point. And then from there, we add to that a reward, which we call the equity or market risk premium. And this reward essentially shows us the excess return that you would generate on average for investing in the market. In the US, this would be like the S&P 500, for investing in the market above and beyond that risk-free rate. And this is where beta comes in. So beta allows us to take that average level of expected return and dial it up and down based on the riskiness of an individual company. So for example, if we were looking at a company that had a lower level of risk, we could dial down our expected return. And if we were looking at a company that had a higher level of risk, again, relative to the market here, we could dial that expected rate of return up. And in short, this is the function of beta in finance. It essentially allows us to say, okay, there's an average rate of return. And if we look at a particular company, is that company more risky or less risky than the market on average? And we can dial then to the expected rate of return for the riskiness of that particular company. And so that's the high level view of beta. With that covered, let's now dive into how we actually calculate this beta number. Now let's take a look at how we actually calculate beta. And if you recall, what I just said is that we're looking at the return of an individual company or the riskiness of an individual company relative to the market as a whole, the average riskiness of the market. And that's actually how we calculate this beta number. So we'll look at the return of a particular stock over a period of time. And we'll also look at the return of the overall stock market, usually the S&P 500, over that same period of time. And to get to beta, we create what's called a regression analysis where we look usually back over 5 years. Sometimes it's 2, sometimes it's 3, but the standard is 5 years backward to assess the relationship between the individual stock's performance and the overall market's performance. And if you're thinking, I have no idea what a regression analysis is, that's totally fine. Don't sweat it. You don't actually need to know how to calculate beta on the job in most cases. And so if you're thinking, I don't really know what a regression is, I want to hop ahead, I've actually got 2 explanations here for how to come up with beta or how to conceptualize it. And so for the folks who want to see the guts of this, just carry on here and I'll walk through the actual regression math and what's going on there. If you want to carry on past that though, you'll see right after that is a second explanation where we have 3 scenarios with bar charts that are popping up. And I just hop straight to that because that's really the root concept of beta that you need to understand, particularly for interviews and generally for your usage on the job in investment banking and private equity. So with all that said, let's hop ahead and take a look at how we come up with and apply this beta concept in real life. Now let's take a look at the regression analysis that gives us the output of beta. And to begin with here, we're going to imagine we have a simple XY axis where on the X axis we have the return of the market as a whole. And then on the Y axis, we have the return of an individual stock that we're analyzing. And if we were to plot out the relationship between the return of the market and the return of the stock, you might end up with a dot plot that essentially looks like this. And the regression analysis runs a straight line through that set of dots and essentially tries to build a line that's a best fit line for the relationship between the return of the market and the return of the stock. Now that line's formula would look like this. We'd see y equals mx plus b. And I should note that b is the intercept. That's where the line crosses the y-axis. It's kind of an aside from this conversation, but just wanted to note that for now so it's kind of out of the way. And in short, we could plug a particular x or return of the market into this formula, and that would output a particular rate of return for the individual stock along the line. And in short, Beta is the slope of this line that essentially defines the relationship between the return of the market and the return of this individual stock over time. Now, if you're still sitting there thinking, I have no idea what you're talking about, that's totally fine, because as you'll see on the coming slide, ultimately the root concept is just a relationship between the return of the market and the return of the stock. And there's just a simpler way to look at this, which is what we're going to cover in the next slide. Now, to walk through the more root level concept of beta here, we're going to imagine 3 different scenarios with 3 different stocks. And in the first scenario, we'll imagine that when the market's up 10%, that the individual stock in the first scenario is also up 10% on average, and vice versa would also be true. So if it were down 10, it'd be down 10. So this stock essentially follows the market over time. In that case, we would say that this individual stock reflects the average riskiness of the market, or said differently, that it has a beta of 1. So it's a 1-to-1 relationship between the stock's movement and the market's movement. Now, in the second scenario, we'll imagine that when the market's up 10%, that the second stock is up 20%, or twice the rate of return of the market. And again, vice versa, if it were down 10, it'd be down 20. And in this situation, we would say that the stock has a beta of 2. And you're going to find higher beta stocks in places like technology or anything that's more high risk. So high risk companies tend to bounce around more over time relative to the market. And then finally, in the third scenario, we'll imagine that when the market's up 10%, again, on average, the third stock is only up 5%, and vice versa, the other direction. And in this case, we'd say that this individual stock, this third stock, has a beta of 0.5. And this type of scenario arises when you have more stable companies like a consumer staples business, like a Campbell's or a Kraft or something like that. Or alternatively, maybe like a utility company that's more stable. And in short, this relationship that you're seeing here is really the root concept that you need to pin down for beta, both for interviews and on the job. And then beyond this, what you need to tackle is what we're going to cover next, which is the concept of unlevering and relevering beta. Now, before we jump ahead, I want to stop and quickly note that if you're finding this helpful, we have a lot more content just like this in our courses on our course site at courses.financeable.com. Now, I want to note that we're going to cover the full concept of beta here. This isn't a bait and switch. We aren't going to give you part of it and then leave you hanging. But if you want to dig even deeper, if you're aiming for investment banking, private equity, or investment management, definitely check out our courses. With that said, let's now jump into unlevering and relevering beta. Now that we've pinned down the core concept of beta, let's dive a layer deeper here. And to do that, I want to show you that beta essentially breaks down into 2 major components once it's calculated. You have, in the first component, what's called systematic risk. And then on the other hand, you have what's called unsystematic or sometimes idiosyncratic risk. And these are the 2 underlying risks behind beta, at least conceptually. Now, to go a step further here, the systematic risk is really just the market risk of the company, meaning how will the company react to changes in the market as a whole. And in a finance theory sense, essentially this is the risk you can't diversify out. It's always going to be there, and there's always going to be some risk related to the market as a whole. And then beyond that, you have company-specific risks. And the first risk is what we call industry risk. So to give a real-life example, if you're Microsoft, you have risk related to the software industry as a whole. But then you have company-specific risk, which is the risk of the individual company. So this would be Microsoft's risk as opposed to the whole software industry's risk. And then beyond that, and really most importantly probably here, we have what we call the capital structure or cap structure risk, which reflects the relative weightings of debt and equity within a company. And in short, when we have debt within a company, it adds risk, all else equal, and that changes the way the stock moves around and the riskiness of the company. And with the formulas that we're about to learn, you can actually unwind this capital structure component and pull it out of beta. And that's what we're going to cover on the coming couple slides. So to begin with here, when we look at beta, when we calculate the baseline beta, what we're generally calculating is what's referred to as the levered beta, which is often denoted as beta sub L or B sub L. And that's the equity beta, essentially the beta of the company with the capital structure of the business as is. And as I previously mentioned, you can unwind the capital structure component of the beta and pull it out of beta to get to the more root level risk of the company as a whole related to the market, the industry, and the company itself. To do that, what we'll do is we'll take the levered beta and then we'll divide by 1 plus debt over equity, so the ratio of debt relative to equity times 1 minus our tax rate. And what that does is it pulls the capital structure impact out of beta and gets us to what's called an asset beta, which is the beta of the business excluding the impact of the capital structure, or also called the unlevered beta, often denoted as beta or B sub U. So in short, now stepping back, we can take a levered beta, the standard beta that you would pull out of the beta calculation, and extract the capital structure impact to get to the root risk of the business absent the capital structure. Now, as we'll see on the coming slides, you can also go the other direction. And beyond that, we'll also see how this is applied day to day on the job, which also ties into some interview questions you might hear as you go through the interview process. So now we'll go the other direction and we'll start with an asset beta. And if we started with an asset beta, we can actually add in the impact of the capital structure by essentially just flipping the formula that you just saw. So what we'll do is we'll take the unlevered beta, and then we'll multiply that by 1 plus debt over equity times 1 minus the tax rate. And in doing so, what we're essentially doing is inserting the impact of the capital structure back into beta, and then we work backwards to an equity beta, which is where we first started. Now, a fair question to ask might be, okay, well, we just kind of went 180. Why would you do this? Why would you go to asset and then back? And that's what we're going to cover on the coming slide. So one of the more common use cases of this unlevering and relevering beta is when we look at privately held companies where we need to calculate the beta for the company, but the company doesn't have publicly traded stock, and so there's no way to actually calculate beta. So for a private company, what we'll do is we'll look at publicly traded peers' levered betas. We'll unlever those betas to extract the impact of their individual capital structures. And then you'll usually take the average or the median of the relevant peers, and then you'll plug in a capital structure. And there are a few different ways to attack this. So you could put in the target company's capital structure. If the target company that we're trying to value or ultimately calculate the beta for has a new target capital structure, we could throw that in. And then sometimes, more from a theoretical perspective, you might also see people take the average debt to equity ratio for the industry and apply that as well. So there are a few different ways to do this in practice on the job, but the short story here is that what you're trying to do is take the peers, pull out the impact of their individual capital structures, and use that as a proxy for the level of riskiness of this private company, and then plug in some version of a future capital structure to give a sense for what the implied equity beta or levered beta would be for the privately held company. So that's really the real life use case of this unlevering and relevering. And that's also what you're going to often hear in interviews is, how would you come up with a beta for a private company? So hopefully that's more clear. And on that note, before we wrap up here, I'll cover a few common interview questions related to the concept of beta. But first, I want to quickly show you where you can actually pull the beta number from an online platform. So if you're asked to grab beta either on the job or as part of a project, you can see where you'd actually extract that number. So that's what we're going to cover quickly, and then we'll take a look at common interview questions related to beta. So as I previously mentioned, you generally don't need to manually calculate beta on the job, but rather you'll have to pull it out of a system. And I've got an example here of Koyfin, which is a great platform for grabbing financial data. It's relatively low cost for individual users. When you get to the job, you'll probably use FactSet, Bloomberg, or Capital IQ. But particularly if you're a student or someone just looking to do some basic financial analysis, Koyfin is fantastic. And you can see here, when you get to the main dashboard for a snapshot of a company, you will find the beta just sitting right there, and they've already calculated it for you. So again, you generally don't have to calculate this. And if this were, again, Bloomberg, FactSet, or Capital IQ, you wouldn't have to calculate it either. They just give you the number, and it would look something like this. But hopefully that gives you a sense for where you'd find beta and what it looks like. With that covered, now let's hop ahead and take a look at some common interview questions. Now let's take a look at some common interview questions that you might encounter that you should hopefully be able to answer after going through this video. To begin with, there's just the general concept of what is beta. And then beyond that, you might be asked, how do you calculate beta? And you won't be asked to actually make the calculation, but more conceptually, how do we calculate it? And the short answer there is just it's a 5-year backward-looking regression analysis in most cases. And what you're looking at is the relationship between the market and the stock. Then there's what types of assets might have a high or low beta, which we covered. And then from there, what's the difference between unlevered and levered beta? How do you unlever and relever beta, or what's the formula to unlever and relever beta? And then finally, how might we come up with the beta of a private company? And hopefully after completing this video, you have a much better sense for how to answer these questions. So with that completed, let's hop ahead here. So hopefully at this point, you're feeling a little bit better about your beta skills. If you found this video helpful, definitely hit the like button down below and subscribe. And then beyond that, if you want to check out more, as I said, we have a lot more at courses.financeable.com. Thanks again for checking out the video and hope to see you soon. Take care.